Hey everybody, welcome back to another beautiful day in real estate. Today we're going to be talking about the side-by-side comparisons that if the Fed cuts rates versus doesn't cut rates, what are the potential outcomes going to be and why are they leaning towards and why is it becoming more pertinent that they're going to be cutting rates rather than not. So let's jump right into the interest rates before we do that and talk a little bit about what's going on currently. So interest rates are actually moving slightly downward today, which is good news. The reason that the interest rates are moving down is because it sounds like Iran and the United States are potentially reaching a deal. If this does happen, then we can expect to see the Strait of Hormuz open up. If we see that happen, all of a sudden the strangulation that has been happening on oil supply and other product is now going to be flowing once again. It will take some time to see things normalize out, but right now, from a logical perspective, I find it very hard to believe that a petty war, and I mean, obviously obviously it's very important, but to the grand scheme of things, this is a very small conflict in the entire world that is going to cause major issues with other countries. And I just don't believe that many countries are going to sit back and let these two go back and forth without some sort of repercussions, right? Because the longer it stays closed, the higher gas prices are going to go, the more jet fuel is going to cost, so plane tickets are going to go up, the more the cost of product for being transported is going to go up, the more you're going to have less oil to create products. Oil's in a lot of different products, not just the stuff that goes into your car. So from the logical perspective, it's been shut down for quite some time, man. I want to say over 30 days now. It could be less. I think it was close to 30 days, something at this point. I think 422 actually is when they were supposed to have that ceasefire deal end. Anyways, long story short, there's a rumor that came out this morning, which is what we'll jump into first, and oil prices came down. Oil prices collapsed below $96 a barrel as it reports that the U.S. and Iran are nearing an agreement brokered by Pakistan. The agreement is expected to be established a joint monitoring mechanism in the Strait of Hormuz. Full outline of expected terms included below. So they did bring this out. Oh, perfect. This is awesome. I didn't even see that right away. Okay. Final draft for the U.S.-Iran agreement. Immediate and comprehensive ceasefire on all fronts. Yeah, no kidding. All parties mutually agree to refrain from targeting infrastructure, meaning that they're not going to be attacking things that are non-military related, which is obviously very important. Freedom of navigation of the Persian Gulf. Strait of Hormuz is guaranteed under a joint monitoring mechanism. So the United States and Iran would monitor it together and without shooting at each other or dropping mines in the water. Wow, that would be really helpful. 4, sanctions will be gradually lifted in exchange for Iran's compliance with the terms of the deal. Perfect. Negotiations on outstanding issues will begin within a maximum of 7 days. Perfect. That means we're moving towards the right direction. Iran's president, I can't say his name, is leading efforts to restrain the IRGC from overstepping on political and diplomatic policy making. The agreement is expected to be announced within the next few hours. Oh, shoot. This came out this morning. Or no, this came out yesterday. Okay, well, we didn't see anything necessarily happen just yet, but this is moving in the right direction. We kind of knew that they were working on this to begin with, and I was just kind of curious to see what the end result was. I think we're getting closer to it, right? I mean, things are you're starting to see some stuff move. Obviously, the big problem right now is that it's the uranium side of things. It's the nuclear side of things. The United States does not want Iran to have any nuclear product, and they are arguing and pushing back. However, we're getting to a point where we have to remember too, where Iran has so much oil in their reserves or in the reserve amount that they have that they are going to have to shut in wells unless they can start transporting oil very, very soon, which is going to cost millions and millions of dollars. So basically what the United States is trying to do is strangulate Iran from being able to continue oil production and cost them millions and millions of dollars if they don't comply with this, basically bullying them their way into what they want, which, I mean, if you have the bigger stick, that's the thing, right? So anyways, let's talk about crude oil a little bit. So from a technical perspective, you guys, we talked about it slightly yesterday that it was kind of seeing its, again, high, high, lower high, lower high. Now we're bouncing down. My best guess is we're probably going to bounce right off this 94 range, and then it's going to kind of pounce back up and go right off that 100 and then back down again. Potentially, right? If we get a peace deal that actually comes to fruition, this could drop all the way down to $83 a barrel in a matter of hours. So right now the market is getting ready and it's anticipating that we're pricing in a peace deal. But to be fair, we priced in a peace deal here, and now here. So, I'm sorry, 1, 2, 3, 4. There's 4 attempts for a peace deal. So maybe number 5's the deal, right? But I mean, from the perspective, unless some major volume comes in, it sounds and it looks like the volume's kind of dying down. Because if it was continuously going higher, we would see pushes in the higher range. I don't know. Oh, let's stay optimistic for today. Let's just see what happens, essentially. But, whoa, don't know what that's all about. Let's get rid of that. All right, there we go. I need to get that out of here. All right, let's continue on. So U.S. Treasury bonds actually fell off a cliff here, which is super nice. Ooh, that looks good, actually. We saw, an engulfing candle. That's very nice. When you see that the red candle is bigger than the green candle, it's usually a positive sign we're moving down as we are moving into this morning. And we kind of talked about yesterday, 4.61 was going to be that next resistance point. 1, 2, 3 resistant points right there. And then you have high volume here. My guess is we're more than likely going to head down to that 4.43 range, especially if we get a peace deal. Again, we need some sort of relief on this aspect, but this falling off a cliff is partially why these are going down, right? When 10-year bonds go down, mortgage rates go down. So that's a positive thing to see. It means that we're moving in the right direction. It makes people feel a little bit more comfy inside. And with the S&P 500, we saw our tiny little dump, and now we're seeing a recovery as we continue to move through it. Let's get rid of this. Don't need that anymore. Okay, so now we're kind of retesting. If it breaks above this 29,000, what am I on right now? Oh, that's right. There we go. That doesn't make any sense. All right, now we got to push our way up and retest the all-time highs of 716. Sorry, 7,516. If we go from there and it breaks above, I'm guessing we're going to be seeing ourselves closer to the 7,800 range in the next few weeks. Bitcoin right now is just doing its thing where it's bounced up into a bearish channel, broke below that bearish channel. Now it is bouncing below another bearish channel. There is talks, if you're a trader, where you're kind of expecting it to go down to that $58,000 range, which possibly could happen before making its next major move up. Really, it's just going to depend on what's going on with the war in Iran. So all that being said, things are still, they're moving again, and they're moving in a positive direction, but we're not quite there yet. So until we see some certainty behind it, the market's kind of wishy-washy. It's going to move up. It's going to move down slightly. But things are also throwing a wrench in the works is today, President Trump is going to be swearing in Kevin Warsh as the new Fed Reserve Chair. This is a big, big deal. We had Jerome Powell in there for the past, 8 years, I believe, is when he was sitting in there. 8 years he's been sitting in the office making decisions and coming out where we are going to miss that good afternoon at the beginning of each speech. But here's the thing. That's another thing is Warsh is working on growing his way out of the economy. Okay, so we'll talk about his mentality, and then we're going to let's break down side-by-side comparison. So scenario A, Fed cuts. Scenario B, Feds hold, right? So they cut rates by 25 to 50 basis points to 3 to 3.25, where we stay at 3.5 to 3.75 through 2026. What happens is when you cut rates, now you have inflation going up. However, you have more people going in and spending money, right? Because when interest rates are low, more people are willing to spend money. When their interest rates are low, more people are willing to borrow, buy cars, buy boats, buy a house, whatever the case might be. Spending increases, right? So you see growth in the economy, but being the economy is now growing and there's higher demand, it also means that the inflation follows, right? What's economics 101? If you have high demand and higher demand than product, the prices go up, right? That's just how it works. It works in tandem. Now, if we drop interest rates, then we're going to see interest rates going to the 5.5 to 5.75 range again, which we haven't seen beginning of this year. We saw for like a short couple of days. That saves about $255 a month on a payment. Wow, that's crazy. Claude pulled that up. 5.5 million additional households would qualify at 6%, more at 5%. So more people are going to qualify for being able to buy a home. The affordability thing, right? Rate lock effective eases, more existing home listings hit the market. So basically what it's saying, it would be good for the real estate market because when interest rates go down, people feel like they can move into a bigger house again, right? And those who are still sitting on the sideline who feel like affordability is a major concern, right now they feel more confident. They feel comfortable. When interest rates fell into the 5s earlier this year in March, right before, or February, right before the war started, dude, my phone lit up for a week. It was just like, it went nuts. Don't get me wrong, we're still doing good this year. We did the math yesterday, $10.4 million in pending sales going currently. That's insane to me. I started out in real estate my first year. I did 5 million. Now we're pending double that. That's just nuts. But anyways, so the idea is that if we lower interest rates, the more money's going to flow. You're going to create more economic growth, but you're also going to see inflation go, right? So the Fed has to decide: do they want to see inflation happen, or do they want to see, or do they want to strangle the economy a little bit more, so to speak, right? So let's say they hold rates, or they cut, or they raise rates, right? More realistically, they could raise rates, right? what's going to happen is if they do raise rates, now you are again going from what we at 3.5, 3.75 currently to that 3.75 to 4 range. Right now, interest rates are going to go up. Less people are going to go out and borrow. Less people are going to go put stimulus into the economy. It's going to strangulate the amount of money that's flowing through the economy to a certain extent, right? By doing so, it means that it's going to be harder for people to spend money, which is the thing, right? People right now are already feeling affordability issues. If you raise interest rates, all of a sudden real estate becomes out of touch for a ton of people again. And we're back to square one. Inflation might be ticking down, but we're not seeing economic growth. We're not seeing the growth in the real estate market. We're not seeing growth for people borrowing money to stimulate and continue to create businesses that are going to generate more revenue, right? So you can do one or the other. I mean, there's really no in between, and they are trying to play neutral right now, which is why rates aren't moving up. They're not moving down. They're just trying to figure out what's going to break first. Is inflation going to break first, or is the consumer affordability going to break quicker? Right now, it's already super expensive for people to buy things, right? If they want to buy groceries, go to Costco now. Like, don't get me wrong, Costco's still fairly priced for, in my opinion, but it still is like every time I leave, it's $250, $300. I mean, imagine you have to go there 3 times a month just to feed your family. That's over $1,000, $900 ish, right? And you notice in grocery stores, things are going up. Your gas tank is now, North Dakota, we were at $2.98, something like that. Now I'm up to $4 and some cents. Most people absorbing that, it's getting harder and harder to absorb that, right? If you're not making well over $150,000 or $100,000, a lot of people are kind of starting to feel it. Now, don't get me wrong. You can survive off of $50,000 a year. I've done it, right? I did it. I saved. I paid for a wedding. I did the whole 9 yards. But the thing is people aren't comfortable in those time frames. And when people aren't comfortable, they're not spending money, right? They're trying to save it, or they're trying to do what they can to feel comfortable. That's the whole point of what people do, right? We work hard so that we can make ourselves comfortable. And when interest rates are not going down and they're going up, the vice versa is happening. So it's just sentiment is starting to fall off of a cliff, right? So, oh no, I just clicked out of that. That's disappointing. Okay. So private credit defaults just hit all-time highs at 6%. Investors pull a record of $14 billion from private credit funds in 2026. That's up 146% from Q4. Some funds already gating redemption. So this, we talked about this a couple of weeks ago, where big companies, JP Morgan, crap, I can't even remember. I think Blackstone was one of them, and then I want to say BlackRock. BlackRock was another one, where basically they capped the amount of redemptions at 15%. So only 15% of the people that wanted to pull their money out of the private credit markets were unable to do so. That draws for concern, right? Because why, unless there's an issue, they wouldn't have stopped the amount of money flowing out. What's happening is that people are trying to pull their money out, and these companies are over leveraged. And the fact that they're over leveraged, they don't have capital on their balance sheet to pay back the investor, right? It crashes the market. So instead of coming out and literally telling us that, they're just like, oh, no, we're just going to cap on at 5% or 15% or whatever it was. And good luck. Like, it's crazy to me how people think that their money is as accessible or as liquid just because it's in paper assets. That doesn't mean that it's accessible nor liquid, right? People argue that real estate's not liquid. It's not a liquid asset, blah, blah, blah. Neither is the stock market. We've seen it before where, I mean, granted, it was a bit of a unique situation, but in GameStop, they halted trading because it was going up too quickly. And I was paying attention to a interview talking about how GameStop became very important because it showcased that the Main Street can actually screw Wall Street, so to speak, over time because of how they borrowed against it. But anyhow, my point is, your cash isn't as liquid as you think it is, and especially in these markets, which, if those of you don't know, the private credit market was created in 2008, right after the financial crisis. So basically, the swaps just went to a different part of the market, and they renamed it, they restructured it. They said, we built more regulation behind it, and they kicked it down the road as they did. Now we're in 2026, and people say, well, we're going to see a new 2008. That may be so, but it's not going to be real estate that crashes the market. The side-by-side comparison, I believe the article that I just kicked over was China. So China right now is having a financial crisis. Why? Because they have an insane amount of inventory and nobody able to buy them, right? And that is why there's a financial crisis in China, or a real estate crisis. And for those of you that might not remember, but Evergrande was the biggest real estate investment in China. It was on there. I remember, can't remember what it was. It was an investment fund, developing fund, and it collapsed. It was like $1 trillion collapse. It was absolutely one of the craziest things I've ever seen in real estate. But what happened was, is they over leveraged. They built a bunch of homes. They couldn't sell the homes. It went into default. They couldn't get a bailout, and everything imploded. There's hundreds of thousands of homes in China that are unmanned. Nobody lives there. Nobody's buying them, et cetera, et cetera. That's the issue of a real estate crisis. We're not there in the United States, but we are in a place where the private credit markets are becoming more and more unsustainable. And when they're unsustainable to this notion, it's now going to create more uncertainty. All right. So if the private credit market starts to crash and the debt for student loans starts to crash and then car loans start to crash, right? Now we have a plethora of trillions of dollars that is no longer sustainable, and it implodes. The only way to get away from this is to print money and make the economy grow. It's not just printing money and saying, here's a stimulus check, right? No, but it's printing money to prop up the market so people feel confident, so they can bring interest rates down, so that more people spend money, so that they can create liquidity, so that they can continue to kick the can down the road. If they don't do this, the market's going to get smaller and smaller and smaller, and it's going to strangulate itself, and then it's going to implode because there's no liquidity in the system. That's the issue that we have to be paying attention to, is that if liquidity doesn't come into this market, that is where we're going to see problems. But this is why I'm believing in tinfoil hat me with me for a second. This is why I believe the financial system is shifting. They are freeing up liquidity to instant settlements, instant transactions, and being able to transact and send money across borders instantaneously or within 10 seconds, right? For very minimal fees. By doing so, you release liquidity from banks. Banks don't have to hold on to liquidity to receive money or send money, right? All they have to do is they have to settle on these rails, and the rail says sent, received, settled, done, right? Right now it's send to a clearinghouse, to another clearinghouse, to here, submitted, and then, or excuse me, received and then settled. So it takes 3 days to do that in some cases. In one case, a mentor of mine did a video where he was talking about how he sent something back and the refund was going to take 3 weeks because that's how slow the system works. So for me, it makes, again, from a logical perspective, it makes sense that we have to upgrade the system so that we can settle transactions quickly, so that we continue to see more liquidity flow into an economy that is being strangled right now. That's what we need to be paying attention to. So again, if the market crashes, it's not going to be because of housing. It's going to be because of private credit, because of student loans and car loans. Those are the 3 major issues right now. And that's why we need to be paying attention to this, because we don't know what the next few months are going to hold. And the longer that they keep the Strait of Hormuz closed, it's creating more and more and more strain on all economies, not just the US, but China, US, Europe, Australia, Iceland, Greenland, Canada, it doesn't matter where you are, Japan, there is strangulation. Russia, Ukraine, all of these countries are now feeling it because product is not flowing, right? So my guess is we're going to more than likely see interest rates drop this year. It doesn't seem like it. It doesn't feel like it, but they're going to figure out a way to drop interest rates so that more money can get pushed into the system. They're going to continue to print money, and then people are going to go out and buy homes. They're going to buy cars. They're going to borrow, buy a boat, buy a side-by-side, buy a camper, whatever, because money is cheap to borrow again. And until that happens, people are going to be in this limbo, which I believe this limbo is only going to last so long. This limbo is only going to last so long before it finally just eats itself up. They're waiting in the middle. It's like they're standing in the middle of a divided highway right now, and cars are flying by, right? Right now they're missing, but at one point, these cars are going to get too close and they're going to crush it. So they're going to have to make a decision. Are we jumping in the left lane or are we jumping in the right lane? That's what's important right now. So for those of you that are paying attention, thank you for watching. Make it to the end. Like and subscribe for more videos. We're going to keep explaining how the economy works. We're going to keep talking about what we're expecting, so that over the next 6 months, and I always use a 6-month overview because 6 months is long enough to anticipate and not necessarily hold with our pants down behind our ankles, right? It gives us we can look at data now to expect 6 months from now, and we can look at a logical perspective to figure out potentially what next moves are going to be. Right now, the sentiment is very low. House sales are the lowest they've been since 2008. People are feeling the strain. Something is going to shift to help with that. It may not be good for the long term, but the short term, I'm expecting to see something happen. Save this video for later because if I'm wrong, I'll eat crow. But right now, all things are pointing towards making quantitative easing and lowering interest rates over time. Not immediately, not tomorrow, not this week, not next month, but sometime this year, we're going to see interest rates drop and more liquidity pushed into the system. It just makes sense.